Stop scrolling. Breathe. Because something just snapped in the silver market, and it didn't happen over months. It happened in about an hour. This is the story of China's silver kill switch. The moment the paper quote stopped acting like the boss, and the physical market started acting like the judge. And before we go further, we're staying strictly on market mechanics. No politics, no slogans, just structure, flows, and consequences. What kill switch means. For years, silver has lived in two worlds. World A, the paper world. Futures and forwards, massive leverage, lightning speed trading. World B, the physical world. Bars, immediate delivery, real shortages, real premiums. Most days, World A sets the headline price, and World B grudgingly follows, plus or minus a premium. A kill switch is what you call the moment that relationship breaks, when the paper quote can't pull the physical market back down, when the tail stops wagging the dog. The 60-minute sequence. In the last hour of trading, three things hit at once. First, an HFT disruption. Reports indicate that co-located high-frequency systems at the Shanghai venue were forced to unplug, relocate, or lose priority access. Translation: the scalping engines that thrive on micro moves and latency advantage suddenly couldn't play the same game. Second, a margin shock. A final margin requirement hike to 20% for silver futures. That's not a headline, that's a lever. When margin jumps fast, anyone running thin capital gets one choice. Post more money now, or cut risk now. Third, the premium widened like a ripped seam. COMEX paper prints struggled to hold around $90. Meanwhile, Shanghai physical quotes surged above $104, a spread of roughly 14s, inside a single hour. That is the kill switch in visible form. Why HFT matters more than people think. Let's make this simple. High-frequency systems don't need to be evil to change a market. Their job is to harvest tiny edges at massive speed. They fade spikes, scalp momentum, and lean on the order book. In a tight, levered market that can create a familiar pattern, price tries to jump, then gets slapped back into line again and again until traders stop trying. So if those systems lose their edge by rule change, relocation, or access restriction, the market doesn't become free. It becomes different. It becomes slower, thicker, and more honest about stress. Because without the instant slapback, pressure has room to show itself. Why a 20% margin is a death blow to weak shorts. Imagine you're short silver on leverage. You're not holding metal, you're holding exposure. Your survival depends on two things. Price doesn't run too far against you too fast. The exchange doesn't suddenly demand more collateral. A fast margin hike breaks that math. If you can't meet the new requirement within the hour, you're forced to cover. Covering shorts is buying. Buying lifts price. Lifting price forces more shorts to cover. That's the cascade. And the key detail, this isn't a slow unwind. A margin lever turns time into a weapon against over-leverage. The two-tier price is now obvious. Here's the cleanest way to describe what traders are seeing. Tier 1, paper reference pricing. Fast, liquid, leveraged, and vulnerable to liquidity illusions. Tier 2, physical scarcity pricing, slower, stickier, and brutally anchored to one thing. Can you actually source metal at size for delivery right now? When the physical tier prints $104 and the paper tier prints $90, the message is not arbitrage will fix it overnight. The message is moving real metal is harder than moving paper. Shipping, vaulting, converting contract forms, meeting delivery specs, those frictions become the wall. And when frictions become a wall, gaps become regimes. The numbers on the board, Jan 24, 2026. Let's lock in the data points you need. Shanghai physical quote, $104.20 Aussie. COMEX paper quote, $90.15 Oz. Arbitrage gap, $14.05, and alongside it, inventory draw, 86% Shanghai. HFT status, reported as banned, restricted at the venue. Whether every rumor is perfect is not the point. The point is what the tape is screaming. Scarcity is pricing itself faster than paper can contain. Why the gap can get worse before it gets better. People hear arbitrage and assume magic, but arbitrage needs three ingredients: metal available, transportable, and financeable. If inventory is already drained, available metal is not sitting around waiting for a clever trade. If demand is industrial and continuous, metal is consumed, not recycled back into the market. And if margin rules tighten, financing the carry becomes harder, not easier. So the gap doesn't automatically collapse. Sometimes it expands until something breaks or reforms. What 44 company export control does to flow? This is the supply valve. When export channels narrow to a small set of approved routes, the market doesn't just get restricted, it gets predictable, like a funnel. Less leakage, More domestic retention, more stable procurement for large buyers, and less surprise supply showing up where the premium is screaming. That's how premiums can stay elevated, not because everyone panics, but because flow becomes managed and slower. The real consequence: paper confidence. Here's the part people miss. Paper contracts are confidence machines. They work when most participants believe delivery is available if needed, even if almost nobody actually takes delivery. But when physical trades far above paper, confidence starts to wobble. Not overnight. First it's a question, then it's a just-in-case hedge, then it's more delivery requests, then it's inventory stress, then it's tighter rules. And once rule changes accelerate, everyone notices, because rule changes are admissions that normal balancing failed. The force majeure risk, in plain English. Analysts are warning about a scenario where a major venue can't deliver on time and must settle in cash or delay delivery. That's what force majeure means in market terms. The contract becomes a payment promise instead of a metal promise. No need for drama, just logic. If too many people ask for bars at once and the bars aren't there, paper turns into a different product. What you should watch next. A simple checklist. If you want to track whether the kill switch is real and lasting, watch these. The spread. Does $104 versus $90 persist, widen, or snap back? Inventory reports. Do deliverable stocks keep falling? Backwardation signals. Are near-month contracts bidding up for now metal? Margin and rule notices. Do risk controls keep tightening? Delivery behavior. Do more traders stand for delivery instead of rolling? You don't need a conspiracy to read these. You just need eyes. The ending. What this hour really was. This wasn't silver went up. This was the market revealing which price is negotiable and which price is non-negotiable. Paper can print. Physical must exist. And if this hour is the start of a new regime, then the headline silver quote will increasingly be a lagging indicator, while the real story lives in premiums, inventory, and delivery. If you want the next update, subscribe. Because if the kill switch has been flipped, the next chapters won't be quiet. The leverage question. Without drama. Some analysts cite leverage ratios as high as 350.1, meaning paper claims can dwarf deliverable inventory. That alone doesn't prove anything sinister. It simply describes how futures markets normally function. Most contracts are offset, rolled, or cash settled. The risk appears when a rising number of participants want now metal at the same time, and the inventory that qualifies for immediate delivery is already thin. Then the market stops acting like a betting venue and starts acting like a queue at a narrow door. Why the premium is the real price signal. A premium is not a headline, it's a message. A $14 spread says, immediate physical supply is tighter than the paper quote admits, and physical buyers behave differently than speculators. Procurement desks don't care about narratives, they care about shipment dates. If a factory needs silver for panels, electronics, or specialized wiring, it pays up to avoid a production delay. That's how premiums can persist even when paper looks heavy. How to watch this like a pro, don't guess. Track the plumbing, spread persistence. Does Shanghai stay above $100 while paper stalls near $90? Inventory trend. Do deliverable stocks keep falling week after week? Time preference. Do near-month contracts bid higher for faster delivery? Rule tempo. Do margin requirements and trading access keep tightening? Delivery behavior. Do more traders stand for delivery instead of rolling? If those 5 stay on, the kill switch wasn't a fluke. It was a regime shift. In regime shifts, leverage becomes brittle. So if you trade paper, size-like margin can rise again overnight. And if you hold physical, understand this. Your advantage isn't speed. It's certainty. The next 72 hours, 3 possible routes. Route 1, relink. Paper catches up, premiums cool, and the gap narrows as metal flows back into deliverable pools. Route 2, two-tier becomes the new normal. Paper stays a reference, but physical trades higher because procurement contracts and logistics frictions keep metal sticky. Route 3, escalation. Premiums widen, inventories shrink, and settlement terms tighten as more players demand bars instead of promises. You'll know which route you're on by the spread and the stocks, nothing else. And if you want to stay safe in this kind of tape, keep emotions small, keep positions smaller, and keep your plan written down before the next spike hits. No hero trades, just discipline.